Live stream here, sorry.
Yeah, you betcha. We'll give you a few seconds, Joan, and then we'll kick this off.
Perfect, we're good to go there.
Awesome. Well, I guess I'll do the standard T&T greeting and say, hey, we're live. So welcome everybody. And yeah, I'm looking forward to chatting with Yasmine and Tim here today. We have another 21 people on the call here too, which is exciting to see. I'll kick it off with thanking our sponsor, which is BDC, which is a Business Development Bank of Canada. For those of you that don't know, they're a Crown corporation. They have $3 billion in assets under management. They do a lot of great work in the venture capital space, which is what we're going to be talking about here today. They've been a strong supporter of Startup T&T since our inception, pretty much. And they have venture funds in things like deep tech, women in technology, industrial innovation, growth venture, and they have a fund of funds. And they typically are a little bit later than the stages that we see companies at here at Startup T&T, but they do some great work propelling companies through that scaling and growth phases, and do a lot of great work in the ecosystem. So thanks to BDC. And with that, I'm going to introduce myself. I'm Neil, the Calgary lead at Startup T&T. I joined as an investor when we first came down to Calgary in 2020. Spent about a year and a half volunteering for the organization, and recently joined as the Calgary lead. Yasmine and I worked together briefly for a little while at Startup T&T a short while ago, and it's been a ton of fun. So today we're going to talk about deal terms and negotiations, and we have two representatives from some great Alberta BCs here to talk that over with. So with that, I'll maybe throw it over to Yasmine for an introduction.
Sounds good. Thanks so much for having me here. Really appreciate it. Yeah, as Neil said, I did have a brief stunt with T&T, which was perhaps one of my favorite times. No shade to Yaletown or anything, but no, I love the crew and love to be in front of entrepreneurs like yourselves. So I'm Yasmine. I'm an investment analyst with Yaletown Partners, but I predominantly work on the Accelerate series of funds. So that's Accelerate Fund 2 and 3 that we are investing out of right now. And do you want me to give a bit of investment thesis background on the fund? Would that be helpful, Neil, right now or later on?
Yeah, absolutely. Let's hear a little bit more about you guys.
Sounds good. So the Accelerate Fund is an early stage fund. We predominantly look at B2B companies in the tech space. We are industry agnostic, so we don't have any one leniency on industry or sector, but we will diversify the portfolio. So you won't see an outrageous number of one type of company or sector or industry in our portfolio. And as well, we are an angel matching fund. So any dollar that gets put in by the Accelerate Fund must be matched by angels or a private investor or syndicate of investors. So our typical check size is about $250,000, can go up or down depending on the stage of the company that we're looking at. And then that gets matched by angels in the community, can be Alberta, can be Canada, could be global. And then besides that, we do look as well for companies that we have potential or follow on. So, your Series A and later rounds could be invested alongside with Accelerate Fund and others as well. But I'm sure we'll get more into deals and how we go about things. So that's all for me. Thanks.
Awesome. Thanks, Yasmine. And we'll throw it over to Tim now for an intro.
Awesome. Thanks, Neil. Hey, everyone. My name is Tim, and I'm an associate at Panache Ventures based in Calgary. So maybe a quick summary on Panache. We're a $100 million pre-seed and seed fund. Similar to Accelerate Fund, we're also industry agnostic. And we write checks between $500K to $1 million. And kind of our mission as a fund is to invest in the best pre-seed and seed founders across Canada. And I think the other unique feature about Panache Ventures is that currently we have about 150 founders in our portfolio. And so whenever a founder joins the Panache family, you have access to all of these founders, and these founders are anywhere between pre-seed all the way to Series B. So there's a lot of kind of like cross learnings that you can get when you join the Panache family.
Perfect. Thanks, Tim. Okay, in terms of like what we're trying to do here today is we have a ton of entrepreneurs on the call with us here, and we just want to talk like as a VC fund from an entrepreneur's perspective, some of the things that you guys look for, so they can ask some questions here in the chat. And I got sort of a list of questions that I want to kick off with here today. And the first one is why. So and I'll throw this out to both of you, and you both can jump in and out as you see fit as we go through here. But why raise versus bootstrap versus venture debt versus small loans? Why go through the venture capital route?
I can kick things off here. All routes of financing have equal and understandable weight to them. I think it depends on the stage of your company and what type of company and what you are trying to use that capital for. So in the typical VC model, you would see a company at the very early stages go after perhaps some non-dilutive or grant funding. They're typically more tech-based, so they have high technology, high experts in that company that would need some sort of kind of seed funding at the very beginning stages, but could be no revenue. So they would need new sources or resources to get that funds in. So, something like a non-dilutive funding can work really well for that early stage until you get into your revenue and can approach VCs or more institutional investors versus an angel, something like that. But all models, all types of capital can be really quite useful. Just depends on the stage of your company. At the very early stage, you will see bootstrapping if you're able and capable. That is also coming from a place of privilege to be able to say, yes, I have enough, capital behind me and my founders to be able to bootstrap, which is putting in your own money, savings, whatever function you've got, or if this is a side hustle, which is always a lot of fun, to be able to fund yourself and your company's needs, whether it's other employees around you or tech and so forth. So there's each pocket of capital makes a lot of sense for the company that you're in, but typically I would say VC and institutional investments would come towards your later stage. So when you're going for that pre-seed seed raise, you've already got some revenue in mind because investors are going to look for it. You've got a good pipeline built out and you have product market fit. At that point, you're no longer testing the market. You have something that you want to go for and scale, and you want to approach investors for that funding to get you to the next level. But it really just depends what you're going after that funding for, if it's growth and scale or if it's, getting product into MVP and people around the table. So I'll maybe stop there and let Tim kind of jump in and we can go back and forth on this.
Yeah, I think Yasmine pretty much touched on all of the kind of major points on what VC is, but maybe just to add to the conversation, like I've read somewhere that around venture capital being like rocket fuel for startups that want to dominate the world, right? So you think about all the best venture scale companies, it's like Shopify, Google, Amazon, Facebook, etc. And it's like only with venture capital could they have achieved what they achieved. And then it's like, if that is not what you want to achieve, it's like venture capital may not be the route to go. And then referencing, I guess, drawing from this article again, it's like the article also talked about how there are a lot of businesses that raise venture capital that shouldn't raise venture capital. And what happens is that they actually end up destroying their business because you're kind of using, you're using a tool that shouldn't be used for that specific business. So it's like, I think venture capital, if you want to dominate the world, if you want to scale 2, 3, 5x year over year, and become a multi-billion, or even a 10 billion plus company within a 10-year time frame, then it's like, raise venture capital, because you can't cash flow a business and grow that quickly, or you can't borrow money from a bank when you're, when you are like a sub 5-year-old startup with minimal revenues. And then I think everything else, I would definitely look for other funding sources. And then on the note of bootstrapping, I think it's like every founder should just bootstrap first, because what happens is when you raise venture capital, when you're still in the the mode of figuring things out versus scaling, which Yasmine touched on, it's you could raise a lot of money, dilute yourself a ton, and then it's by the time you're at that inflection point and truly ready to raise a lot of venture capital, you might be so diluted that VCs don't want to invest in you, because VCs generally want to invest in founders that have enough ownership to stay with the company for 10 years.
Yeah, good points. And I think we're going to talk a little bit about dilution a little bit later. So, but those are great points. It sounds like the velocity is is sort of the match with the venture capital community. And Tim alluded to this in his intro, but what are some of the non-capital things that VCs like to provide, and what kind of things should entrepreneurs look for outside of the actual check going into the bank?
Yeah. I mean, it really ranges, and it's different for every VC, right? So like in Panache's case, our mission as a fund is to help pre-seed and seed founders in Canada get to their Series A, and then ideally raise a Series A from a top tier US VC. And like some of the formal programs we've created for that, or one of the formal programs we've created for that, is a Series A boot camp where we actually bring in VCs from the Valley, and then those VCs kind of give founders their perspective on how founders approach them and how they like to get pitched and stuff like that. So that's one of the formal programs we offer to our founders. And then of course we have a like a Slack channel with all our 150 founders. And then we also have a community person that connects founders with each other for whatever they need help with. So these are ways that some of the ways that we help our founders. And then like in general, there are firms that are more technical in nature or more product focused in nature, and they will help founders build tech, or at least advise on tech or advise on product. Or there are also VCs that are go-to-market experts, and they will help founders, execute on their go-to-market strategy as well as decide what that strategy is.
Absolutely. And Yasmine, how about you? Do you have any answer to that question?
Yeah, of course. I think as an entrepreneur, you really need to think about what is going to be the most beneficial and useful for you at that stage of your company's journey, and align that with the investors you're talking to. So as Tim mentioned, there's lots of programs that VC funds could offer, like startup, boot camps and other types of accelerator or, guidance strategies to your go-to-market and product development. But there's also some VCs that are offering great networks and individuals behind them. Accelerate Fund is co-managed with Yaletown Partners and the A100, something that's a little bit less known sometimes, but the A100 nonprofit organization based in Calgary holds together over 100, tech veterans and these people that have been in the industry for so long in multiple different areas or sectors. So, if you sign up with a portfolio like that has access to those massive networks, you're able to go, okay, I have a problem in my fintech. Can I talk to someone about who has done this before in this space that can actually answer my question a little bit more concretely than maybe a generalist VC like myself? So, it's access to those networks, it's access to who can you talk to for your next raise as well. Sometimes that can be very useful if you're looking for longevity of, seed to Series A, B, and C. Are those investors in your back pocket? Are they able to get you to that next stage and shape your pitch, shape your whole idea, your messaging, and give you those key introductions? So it really just depends on what you are seeking to gain out of that relationship, because it is, it's pretty much, people call it a marriage often, and it is, that 6, 8, maybe even 10-year relationship with that VC or investor. So what do you need from them in that time period, and how can you best leverage their networks and their access points, whether it's relationships, or otherwise more tangible product go-to-market strategies.
100%. Yeah, we love that community building piece of the network at Startup TNT, and that really resonates with us, right? Like this whole industry is a people-based industry, and those connections, whether it be like suppliers or salespeople or other people that have been there a few months before you, can be really impactful, especially for early stage founders. Now I'm just going to take a little quick sidetrack here. So, with the amount of different types of investment asset classes that are out there, what drives like your firm specifically to pursue the venture asset class instead of some of the other things they could be using their capital for? And I think there's a neat story on both sides of the equation as to why your leadership have gone into this asset class. So I'm excited to hear that too.
Sure. Yes, for Accelerate Fund, we're a bit of a unique structure because this fund, Accelerate series of funds, was developed by our LPs, so our limited partners. That is Alberta Enterprise. They're our main LP, and others have come along since then. But their mandate was to go after the Alberta market specifically and ensure that entrepreneurs and founders, great startups coming out of this province, have equitable funding from the very beginning, from that early stage when they're just in early revenues and need to get that boost, like Tim is saying, to get up into scale and future endeavors. So specifically VC asset class, it's a very risky asset class if you're looking to conserve your money or just see smaller rates of return. You're not going to go into the VC space, so go into other, maybe towards public equities or other sorts of mutual fund asset classes. But really, it's like the old saying, bigger risk equals bigger returns. That's really why you're in the game early on, to be able to have founders groups at the early stage, kind of ground floor, and you get to jump into that space, help them mold the ideas, help them mold the project all together, and see them grow and hopefully get massive returns at the end of the day, right? That's what we're all hoping for, to kind of have a seat at the table early on. Specifically for Accelerate Fund as well, we'd like to think of ourselves as a bit of a farm team for Yaletown's main fund, which is the Innovation Growth Fund. And that one looks at Series A and later stage growth rounds. So if you're, aligning with the thesis of our main fund, that's a really nice connectivity into your next round of funding, next line of investors that have even more access into the global market. So that's why we're kind of in this early space. But beyond just the politics of it all, VC is probably my favorite space to be in, especially at the early stages, because it's the most exciting time. You're growing a company from pretty much nothing into what could be the next, I don't know what's the less contentious, Ubers of the world, just, stick with me for a second. But it's the most exciting to see founders with such passion grow and scale a business into who knows what it could become into the future.
Yeah, and for Panache, I think maybe to give you a little bit of a history lesson on Panache, I think 4 out of 5 of our partners are ex-entrepreneurs themselves, and they've all built businesses from the ground up and sold them. So everyone, all the partners at the firm, are big believers in founders. I think partly because they have been founders themselves, and also big believers in tech. And I think purely because of that, that's why they believe in the venture asset class. They themselves have seen the outcomes you can create in the venture asset class. So I guess from a pure financial perspective, they're believers there, but also it's they believe in supporting founders because they've been through the journey. They know how hard it is. And I think they really just want to pay it forward and support the next generation of Canadian founders.
That's awesome. Thanks, guys. We have a question from Taryn in the chat. So he's saying, with the cost of funds rising lately and possibly into the foreseeable future, how do you see the investing space evolve in the next 12 months as it relates to pre-seed and Series A stages?
Hey, Taryn, what do you mean by the cost of funds rising?
We'll give him a second to respond there, but I think we're all seeing a lot of interesting stuff happening in the markets and the economy generally. So maybe he's talking about the increase. Oh, that's Ty, that's somebody else. But maybe you can talk a little bit about just the general state of the economy and what's happening in the venture space. What kind of things you see shaping out over the next 12 months?
Sure. I mean, as we've all, I guess, experienced, it's the public markets have, I guess you could say it's reverted to the mean and maybe even gone below it. And then I think what that creates is kind of this ripple effect where public valuations have gone down, which means IPO valuations have gone down. And then later stage VCs will invest based on what they think they can IPO the company for. So they become more valuation sensitive, meaning that has gone down. And then, and that really trickles down all the way to the early stages. I think it's early stage has yet to fully feel the effect of that. But I think unless, the market rebounds as quickly as it did in, mid 2020, it's I think it will happen where there will be valuation compression in the early stages. And as VCs, we'll just adjust to it, right? We'll invest knowing that you're not going to get as inflated valuations. And knowing that we'll just try to get into deals at more attractive prices.
I'd also add maybe quickly just on the entrepreneur or founder's perspective, what that is looking like for you is yes, lower valuations. You might have to kind of swallow some flat rounds or maybe a down round, just because what's happening on our side is that we are conserving our deal flow, if that makes a little bit of sense. So the pacing or velocity of deals won't happen quite as fast. And maybe that relates to, the interest rates and availability of capital, whether it's the investor VC side or other types of debt structures. the people making the decision will be really tightening their belts, really trying to make sure that this is the deal that we want to go into for the long haul, that you're able to conserve your cash, you're able to manage it appropriately, and you have the right resources in front of you. The past year or so, we were seeing deals, even in our own portfolio, that were changing over another round in 6 months or less, which seems crazy to me. I'm early in my career, but that just seems wild to be able to, that the days of the 12 to 18 months were gone and now they're back. So we're back to that field of, make sure you have enough cash in your bank to sustain you for the long term so that you can raise again in a more 12 to 18 months round. And I would assume, I can't speak from like a loan perspective or any type of bank institution, but as interest rates rise, same thing. They'll be really checking the boxes, making sure that this is the right deal to provide capital to, rather than kind of quick pace getting the money out the door.
Yeah, absolutely. And we're seeing companies like Y Combinator already like put out public statements about being a little bit more conservative with your cash and running a little bit more diligently in terms of your cost controls and stuff like that, right? Which I think is prudent. But before we run too far down that path, I want to switch up because we want to talk about some deal types here today. So the first one, and sort of like the primary one, is owning a stake in a company. So equity. So I don't know who wants to take this one, but who wants to explain like what equity is, what does it look like structurally, what are some of the common terms around an equity deal with a venture capitalist, and take that away, and then we'll chat a little bit about the pros and cons from the entrepreneurial side and from the VC side after it's been explained. So
sure, I can start, and then I'll let Yasmine fill in wherever I miss. But like very simply, equity is just like is literally owning a piece of the company in the form of shares, which can be in the form of common or preferred shares. And common shares are, I guess, common and preferred refer to the order in which the shareholders get paid out. So it's like common shares get paid out last, and then it's like, and then within preferred, there's a preference stack. So you'll have like your seed preferred shares, and then above that it's like your Series A preferred, Series B preferred, Series C preferred. And then when the company sells or IPOs, it's like, well, actually when it IPOs, it's like there's no issue, but when it sells, and if there's not enough money to go around, it's like the investors that invested the most recently, they get paid back first. So it's like the Series C investors will get paid back first, then the Series B, then the Series A, and so on. So it's like, yeah, so that's, a little bit about equity. I think it's a pretty complex subject, and there's a lot of technical aspects to learn about equity, which, to be frank, it's like I don't fully understand all aspects of equity. But maybe the key thing to understand is like when you do sell equity into your company, they are an owner, and they have the exact same rights, and maybe even more rights than you do as a shareholder, especially if they're a preferred, if they own preferred equity in your company. And then, it's like, and when you do sell equity, maybe the most important thing is like, it can affect whether you actually make money when you exit your company at all. Because, for example, let's say you raise, $1 million or whatever. Or actually, let's put it like this. Let's say you raise $100 million, and you end up selling your company for $100 million. It's like what happens is like all the shareholders will get, or the 100 million doesn't get divided equally between all shareholders. It goes to like paying back the investors first, and then as a founder, it's like you could walk away with nothing.
Anything you want to add there, Yasmine?
Yeah, I mean, that is the essential items. I think at the early stage, we don't typically see equity deals as a deal structure. It's nice as a VC to get a straight equity deal because you've got kind of a clean cap table, you know exactly your percentage ownership. And same thing for the founders, at the end of that deal, no matter how much you've raised and then what valuation, what you're walking away with in terms of your dilution and how much ownership you still have in that company and what's left over for your employee stock options, stuff like that. But some terms, and the terms can be pages and pages and pages long. You do get that term sheet from your lead investor. So there's lots to dive into and learn a little bit more about. Maybe some of the key top ones that we've seen are things like, pro rata. So do you have allowance to get into the next round at the same percentage ownership that you have currently? What that really means is, and it can be two kind of different ways. Either you are, if I'm a 5% owner in the company, the next round, I can level up so that I still have 5% in the company, basically to increase my how much I'm providing you into the company to have the same ownership. Or if we accelerate fund took up 25% of the round, we can take another 25% of your next round. So it really just depends on, again, the wording of pro rata, but there's so many terms: option pools, preferences in the sale of the share. So like Tim was talking about, who gets paid back first. Sometimes you have participating preferences versus just your preference shares. So there's a whole bunch of different terms in there that can vary deal to deal. But it's board rights and everything. So there's so many terms. And Neil, maybe you can tell us if you want us to go into some of these more in depth, but you can keep a high level too.
Yeah, no, I think that sort of touches on sort of the big points about it. John's asking a question in the chat here. I'm going to skip your first question here, John, because we're going to talk about convertible notes and safes here a little bit further down the road. But it's more of a general question. But how do your pre-seed funds feel about companies that don't follow pre-seed or seed with a Series A, but instead turn into a profitable company without the need for further raises? So I'm saying, like, how do you guys feel about companies that raise at the pre-seed and seed stage and don't have any further fundraisers down the road?
Yeah, great question. I think it depends what you had raised, like what instrument you raised on. So if you raised on straight equity, and the investors, VCs, angels all had their percentage ownership in that company locked in place, preferences done up kind of nicely. And if that's also how you're going into the deal structure, so it's able to be laid out nicely in contract, I think that's great and fine, because we know what our percentage ownership will be at the end of the day. Although, alluding back to kind of Tim's comment at the beginning, VCs are typically looking for that highly scalable, massive company. So will this company at, even at profitability, get the kinds of returns that the VC is looking for? Typically in this sort of structure, you would see angels, which is fantastic because, some don't have mandates of tripling their fund or more. They just want money back plus a little. Fantastic. But an institutional investor will be looking for a lot more than just principal to come back to them end of the day. So it's not the worst thing in the world, but I think it would be a difficult conversation to have with a VC or institutional investor.
Yeah. And, maybe adding on to that, it's from the perspective of an entrepreneur, it's by like no means a bad thing to create a profitable cash flowing company. And if anything, I think it's like this narrative that you got to raise venture capital. I think it's kind of like there's too much of this narrative out there now. It's like, I think it's like if everyone just created a great cash flowing business and it's like you personally drew 200 to 500K a year from your own business, it's like you would have an amazing life, right? And that would be a great outcome by any metric. But yeah, it's like venture capital. Again, you're putting rocket fuel into companies that want world domination. And it's like, you're not going to be able to dominate the world in a span of 5 years, like scaling just on cash flows, right? And that's not what VCs look for. So it's like, if that is the case, if your intention is to just build a profitable company, within a year, it's like, it's possible that it's just ends up being a lifestyle business, and that's not what VCs want to invest in.
Yeah, that might be applicable for another type of funding arrangement, right? So now let's move on. So we've talked about equity a little bit here. So we'll talk about convertible notes, then safes, and then we'll sort of wrap up like some of the pros and cons of each of them here. But let's talk about convertible notes. So I don't know if Yasmine, you want to take the lead on explaining this one here first, since Tim did the first one.
Yes, I suppose I can do that. No, yes, a convertible note is essentially a loan from your investor that turns into equity in some future time. So the real main key difference here is that you are setting up the terms today on your convertible note, all the deal structure. You do put a valuation on it. You do have some terms around the same thing, pro rata, board observer, all of that. But you're basically saying to the company, or back to the investor, we will be raising funds again. So it's kind of a guaranteed that you better raise funds again or before a conversion event. And at that time, your shares will actually materialize. So to put this into perspective for Accelerate Fund, if we do a deal on a convertible note, we might write down that we've got 250,000 into a certain company. We calculate our fully diluted ownership, which just means total position after all of the other share or positions have been acquainted for. So founders, if you have advisors having shares, you have an option pool. After all of that is paid out, essentially, what is our ownership position? But that's truly not material until you actually have your next round and we convert and we do solidify our position. So typical terms on a convertible note will have an interest rate because it is, like I said, a loan. So you will have some sort of interest rate, either payable annually or payable every half year, but you don't have to pay it out right away. It can be paid out at the very end of the conversion. And as well, a discount rate. That's the biggest, probably pro for an investor to go in on, a convertible note or a safe is that you're saying, in that time frame, in the next year when we raise again, you will receive a 20% discount at that next pricing. So it gives you sort of a win on the one end to have money in early from investors. But then on the investor side, we get a little bit of a break on your next round of funding. And that way our shares are worth more. So that we can get our equitable position in the company at that time. So it's an interesting structure. It's used quite a bit in the pre-seeded seed rounds as a way to get money in the door without having to firmly set your valuation. But you're basically saying, yeah, we're here to grow, and we know we can hit metrics and milestones to hit that either above the cap or at least the cap on whatever your pre-money valuation looks like, and then we can go from there. So that's sort of the idea of a convertible note. But I can let Tim. Same thing that maybe I missed on that part.
No, I think you touched everything on the convertible note, Yasmine. And I guess I can just go directly into the safe if you want, Neil.
Yeah, go for it. Yeah.
So they're similar. I'd say like a convertible note, a safe. Safe stands for simple agreement for future equity, and a safe is effectively a convertible note, but without the interest piece and the maturity date. So if like pretty much what a safe is that, you have a valuation cap, which is effectively a valuation, and a discount rate. And it just, you're pretty much saying to the founder that like, hey, we want to invest in you, but we don't know what you're valued at. So let's just defer valuing your company until you like raise an equity round. And then because we invested in it at such an early stage, we either get like this preferred pricing, which is the valuation cap, or the discount, or like a discount on the next round valuation, whichever is lower. And that's what a safe is. But I think where it differs from a convertible note is that if the founder, because there's no maturity date, if the founder never raises again, it will never convert into equity, meaning that the investor will never have ownership in your company. Will never have ownership in your company. But it's like, I think some safes do have a clause called a liquidation preference, and it can be, it's usually 1x, meaning like the investor will get their money back if you sell the company. So it's like, even if you never convert, but you sell the company, the investor will, at that point, the investor will get paid their money back.
Maybe I'll just really quickly mention, on the safes, we've seen some that are amended. Typically, the safe comes from Y Combinator, that kind of very standard, that's why it's called standard agreement, that all founders can just go ahead and use for their raise. But some have put in conversion metrics into the safe as well, just to align themselves with the entrepreneurs and ensure that there will be a time limit. In 2 years, 24 months, if you have not raised, we will convert automatically at the cap amount. So just be aware, you might see some of those clauses come in or terms come into your sheets in the near future as well, or kind of as you raise out there.
Totally. Yeah, that's a great point, Yasmine. And Tim threw in the chat here too that the latest YC safe, which is a general template that you see pretty often out there, has a term to include dividend payments to investors, to safe holders for this exact sort of reason. So there's some way of getting some of their capital back out of the company if there's never a conversion. And there, I can't remember the name of the company, but there is even a story out there right now where a company raised on SACE and went on to be uber successful, and the investors are freaking out right now because the company's making hundreds of millions, and there's no way to get their capital that they put in early out, and the founder is holding them to the letter of the agreement.
Yes.
And,
Yeah, don't do that.
and another interesting thing that I just want to mention about the convertible note, and this kind of goes back to Tim's talk about the like the way that things get paid out upon a sort of liquidation event for a company, is that a convertible note does put you as a debt holder on a company's balance sheet too, right? So, and debt does sit above the equity stack, like the equity stack as a company gets paid out. So like from a VC perspective, I imagine you guys probably view that as like preferable to a safe, which is what I want to chat about here next. Like from a venture capital standpoint, what's your sort of preference with convertible notes and safes being relatively similar to each other in terms of the structure? Like, how do you guys view each of these instruments, and what's your preference? And then from the founder side, if you guys could sort of put yourself in their shoes and talk about what the benefits from their side or the cons would be from their side as well, that would be great.
Yeah, I mean, maybe I'll start with the founder side, but like safes are definitely more founder friendly than convertible notes because just because there is no interest rate, right? And like I think the interest will effectively make it we'll give the investor more shares than without an interest rate when the note converts. And then as an investor, we actually don't really care if the deal is done on a safe or a note or a convertible note, because that's kind of not the biggest issue when looking at an early stage deal. It's like, to us, the biggest issue is like, is this founder someone we want to back, and are they going to hit it big? Because when a company hits it big, it's like all of these like discussions around like, do you do it on a safe or a convertible note or equity? Like they pretty much don't matter when the company hits it big. So our focus is the company going to hit it big? If they are, we want to invest regardless of like the technicality of how the deal is done.
Yeah, I think just from the VC perspective, I'd agree. It's really no matter to us either what you choose as an instrument at the early stages to use as a deal structure. Typically, the accelerator fund doesn't lead a lot of rounds, so also keep that in mind, knowing what your lead investor has a preference for versus safe or convertible notes or straight equity. And so the others will usually follow on to that same instrument and ensure that the terms work for them. So that's pretty common. You might see a side letter go with hand in hand with your safe or convertible note. So that side letter from the VC might have certain terms that not necessarily trump your safe or convertible note, but will just go hand in hand to ensure that there is a position that is equitable for both parties in both documents. So definitely from VC perspective, no matter to either side. And I'd agree with Tim. Safe is sometimes the easier, the quicker, and more understandable document for founders to raise on or at the early stages. And as well, legal fees. That's the other big item. The safe was, if I'm not mistaken, designed to have your legal fees as low as possible because it was a template document, pretty standard across the board, understood by both. So you wouldn't have to worry about funneling a lot of money towards lawyers and their time and their resources. So that's something to keep in mind as well, but you never know what you're looking for and what might be more attributed to your current stage of company.
Absolutely. And Tim's coming in with another good question, and I was going to ask something about safe stacking here as well. So maybe you could talk about both of them. But his question is, does a complex cap table with multiple different safes or convertible notes ever turn you off of a deal?
It can make it harder to get the deal done, and here's why. So it's like a thing that we're very concerned about at the early stages is founder ownership, and does the founder have enough of the company to stay with the company in the long run? And the reason why that's important is because effectively, like at the early stages, you're pretty much investing in the founder. It's like the market will change, the product will change, et cetera, but like the founder stays the same. So you want the founder to stay with the company for the long run. And if like they don't own enough of the company, it's like they probably won't. You could make the argument that they won't be incentivized enough to build it to $1 billion plus outcome, because it's like if you own a 1% at $1 billion, which is $10 million, versus let's say like 50% for $100 million company, it's like what's better for you as a founder, right? And it's a lot easier to build a $100 million company than a $1 billion company. So it's like there are concerns that the founder won't stay with the company if they own too little at the onset. And I think that's the main concern with cap tables. And then on the point about having multiple safes and convertible notes, I think we've seen founders raise a bunch of safes, and because it's like the dilution doesn't happen immediately, they think it's like they don't actually know what that dilution is. And then when they convert, it's like they go from 100% ownership to like 40 or 30% ownership, because they weren't calculating or estimating their dilution along the way. Then that's an issue, right? Because again, it's like now they don't own enough of the company. So it's like if they have a lot of safes, it can be an issue. But the caveat goes back to like, if they hit it really, really big and it becomes like, if it IPOs at 100 billion, then it's like, there's no more, like the issue is a non-issue anymore, right? So it's like, I think it is a concern, but if we believe it's going to be a really, really big outcome, we might take the risk anyways.
And just before, I know you got an answer here too, Yasmin, but before you get to that, Tim, do you have any good resources for people to be able to track that, right? Like this is obviously an unfamiliar sort of scenario, especially for first-time founders. Is there anywhere that you would point people towards figuring out like what your end dilution is going to be if you've done multiple rounds on safes that you can think of, or any?
I mean, yeah, I would say one is like understand how, I would say, I guess, safe conversion or convertible note conversion really well, because it's like when you understand how things convert, you can just model it out in Excel. And then there's also a tool online for very simple scenarios called like Safe Genie, or it's called captable.io or something like that. I think they're the same thing, but they just changed their domain name. But yeah, I guess just Google that, and that can be I guess that's a tool that you can use to just model out your own cap table.
Thanks, Tim.
Yeah, so and just to follow on Tim Lynn's follow-on question there in the chat, if you are communicating it as an at converted basis of your safes and kind of stack together instruments, it's all good, no red flags. And I wouldn't even say it is a red flag if you say you've got 5 different safes behind us before the Accelerate Fund comes in. Just know that we will do the math to figure out the fully diluted ownership. We will come back to you with a question to say, do you know that at the end of this round, you end up with 20-some% of your company? And that could be a reason that an investor will not come into that round. So it's not necessarily a red flag, but it could be a stopping point for an investor to move forward with you. So just know your position. And a resource I would love to share. I wish I was sponsored for this. I should be. But they're called the Founders Pocket Guides. I don't have the cap table one with me, but there's a convertible debt one and a term sheet one. They've got like 5 or 6. They're like 100 pages, 1 hour read tops. And the cap table one is really good because it gives you a downloadable Excel file that you can use to then and put through your analysis. So you put your founders shares in, you can put your first round, second round, and then go through your valuation and what your ownership position will be with option pool and everything. A little bit on the back end of Accelerate Fund as well. We manipulated it to work for us, but we use that for our own analysis. So it's wonderful. It gives a really easy perspective to know what your dilution is round after round. And if you need help going through it, let me know. Happy to walk you through that as well. But find them on Amazon. They're so easy.
Awesome. And I just learned that Yasmin reads much faster than me, because 100 pages in an hour for me is probably a little bit on the high side. So
Is it not? It's big text. It's very big text. You're
okay,
good.
that helps. Yeah, especially with these old eyes. So I want to shift gears here a little bit and talk about sort of negotiation, like once you've sort of determined a rough deal, and focus primarily on the next 10 minutes about valuation, and then the last 5 minutes about control terms. So the big question, and this is a bit of a loaded one, is how do you guys determine what you think is a fair valuation or a cap for a company?
It's a good question and a tough question. I think how we think through it, first and foremost, at the early stage, it is much less about multiples on your revenue, doing a discounted cash flow analysis or heavy finances to figure out your valuation versus understanding how much of your company do you want to give up. What is the percentage ownership that you are willing to sell off at that stage to not only continue incentivizing yourself and your employees through stock options, shares, whatever it might be, but also to have your investors aligned. 5% might not be enough to get them into your, the weeds of your operation. So do you need to give them more or less, whatever it looks like. So really, it's quite hard because at the early stage, you don't have a lot of revenues first and foremost. And we would argue that sub 1 million in annual recurring revenue is very difficult to put a multiple on it. So, you might see the public markets in your SaaS space, and right now they're like, I don't even know, 6, 7%, 8%, or 8 times, sorry. So, you might see what the public markets are doing and you go, I should be aligned with the public markets. Well, first of all, for a company doing over $1 million ARR, we might even take a percentage discount on the public market valuation. So keep that in mind for, your private sector. But then again, if you're not hitting that revenue mark, if you're not consistently seeing that kind of post-million in recurring revenue, it's likely about how much are you willing to sell, and then working your valuation from there. What do you need today to get you to your next point? So that 12 months, 18 months runway, enough to get experts on your on your C-suite panel, advisors, or whatever it might look like. And then what kind of percentage ownership do you want to give up? And then having that as a little bit of a basis for your valuation. Again, it's not a science, it's a bit of an art, especially at the early stages. So it's a bit difficult, and that's where you can go back and forth on negotiations. But that's where you should really lean on your lead investor to help walk through that conversation. What do you think is fair for you? What are they seeing in the markets? Because they're out there talking to founders and deals all day, every day. So take a bit of if someone's giving you a much lower valuation than what you think you're worth for, talk through why, right? Like we never just give you a number to hardball you. It's usually what we're seeing in the market, what we've already done in deals, or how things are shaping up in your sector. So hopefully that gives a bit of a touch on how we think about valuations.
Totally. Tim, how about you?
Yeah, it's I mean very similar to Yasmine because we play at the same stage, but it very much is like, what else have we seen in the market for something similar, right? And it's like, yeah, you can't apply public market multiples onto your company, but I think it's like you may be able to apply like other like maybe seed, if it's you have revenue, it's like other seed multiples onto your company, right? So I'd say like understand the market that you're playing in, and what the valuations are for a benchmark of what you could be worth, right? That doesn't necessarily mean like that is what you are worth, because there's a lot of stuff that happens under the hood that goes into determining like that specific company's valuation. But like this will give you a frame of reference for what you could be worth. And then at the end of the day, it's like your valuation is discovered when you actually create a market around your company. So it's like if you really want a great valuation, it's like I think the thing to do is get a bunch of term sheets and then you just go out and negotiate with each of those investors to like drive up your valuation. But yeah, it's like it's determined, I think, first based on what the investors are seeing, and then once you get hot, then it's determined based on like how well you're able to negotiate.
Yeah, so if you were like a first-time founder, like obviously this is your first fundraise going through, how would you go about approaching a VC or angel group with a valuation, right? Because that's something that's commonly asked for is your pitch deck and you're asking your instrument, like lots of the things that we chatted about here. What are some of the like resources or ways that you would go about sort of determining a value for your company as an early founder?
Yeah, I'd say don't even worry about that. Like what we often recommend to founders in our portfolios, like when you're raising, just go out with how much you want to raise. And then like the rule of thumb is like, you'll probably get diluted 25%. So it's like, just multiply that number by 4. And that's kind of like what you could expect VCs to throw at you. But it's like, don't say what your what value, like what you're valuing your company at, because what will either happen is that then VCs will fixate on that and you could be a great company, but they'll be like, oh no, you're too expensive for us. Or you'll have thrown out a number that's way too low and they'll be like, oh, it's done. We'll wire you the money tomorrow. And then you've just like, sold your company for less than it was worth. So it's like, I think we always just say, just go say how much you want to raise, let the lead investor give you a term sheet with the value on it. And then once you start having term sheets, that's the time to have a conversation around valuation, right? It's kind of like, it's like until they're interested, there's no point in talking about valuation. And that's how we generally see experienced founders deal with VCs. And then with angels, what we've seen is like usually a founder just throws out a valuation once the angel is interested. And then like, I guess in that case, it's like if people are willing to pay you a very high price, by all means take it, right? Yeah.
But Nathan, Yasmine, how about you? If you were in that situation, would you have a similar sort of path to getting there?
Yeah, that is interesting. It's a great perspective because you're right. We do fixate on valuation quite a bit. If it's too high, we will just kind of go, oh, thank you so much. This just doesn't work for our fund, unfortunately, right? It could work for somebody else. But when it is well priced, we go, wow, what's going on here? I think definitely be willing and open to negotiate or move your valuation if you are stuck on a number. If you do present it and you go, this is what my pre-money valuation is going to be, but I am willing to move or negotiate with the lead investor. So at least it gives a bit of a benchmark of your understanding of the space and where you think you might land. But also you're okay to go up or down depending on what the lead investor might say out there. But when you are going to bat for your valuation, I would definitely talk a lot about your current traction and revenue. So if you do have some of that and it's a basis for that valuation, talk about it. Pipeline can be mentioned, but I would just caution with pipeline. We've seen that a few times where you've got $1 million in your pipeline or contracts about to be signed, but it's not material. And anything can happen at the last second, no matter how close you might think. Even if it's 99%, there's still a chance it could fall through. So, mention perhaps how large of a pipeline you have, but understand this is where your current traction is at today. Be honest and transparent, and that's where you're going for your raise in the future. But also as well, as you're walking through your valuation, understand that in your next round for a VC investor, we're looking to double or triple that position from round to round. So if you're raising at 10 million pre-money today, your next round you should be 20+ million, and so on and so forth. So what kind of revenue do you need to get to the next round to be able to hit those milestones and those metrics? So if you can talk that backwards to an investor, it'll show that you really know what you're talking about. You've done the due diligence on your own, and we can have a conversation from there. But keep it open for sure. I think I would agree with Tim. Keep it open and just listen to who's out there and shove it off to investors like us. Talk to us on a coffee basis. Just say, hey, let's have a chat. What do you think of this number? Would this make you go, whoa, no way? Or let's have a better conversation. So we're welcome to always have that kind of talk.
Awesome. I think that's great advice. So we got about 5 minutes left. So the last couple of minutes here, I want to talk about like obviously we talk about like the economics of getting a deal done, but there's lots of control terms out there that various VCs have alongside their investments too. So maybe just a general chat about not necessarily what your firm does, but just general control terms, some of the like red flags that you see out there that other VCs might be doing or that other entrepreneurs might not be aware of. But just talk a little bit about what control terms you think are like reasonable at what stage and things to look out for.
I guess I can start with this. So in the early stages, like there's actually not really any control terms, especially if you're raising on a safe or even like a convertible note. It's because it's like I think you as an investor, you technically don't get control terms until you're like actually a shareholder. So it's like early stage, it's like it's probably not an issue. And then maybe it's an issue if you raise a seed on equity, and then by Series A, you're probably raising a Series A on equity. And then at that point, like it becomes a concern or it becomes something you need to think about. I don't necessarily want to say it's an issue. But even then, it's like as a founder, if you've structured your cap table correctly, you probably still have majority ownership of your company, which means you still control the whole thing. So even then, it might not be a non-issue. But in terms of, I guess, control, it's like what usually happens at the Series A is that the lead investor will get a board seat. And then they will also request that you have an independent person on your board. So then it's like, that's when you start to form a board. And then it's like the board, I guess like the board has the ability, depending on how the cap table is structured, to fire the CEO and hire another CEO, depending on certain things, right? But that would be the only point where it could be an issue, but assume like for early stage, it's not really an issue.
Yeah, I'll really quickly agree. It's not too much of an issue at the early stages. Some might require a board observer role, so not necessarily any kind of formal position to make changes or decisions at the board level, but to be there for communication and just information. You might get some information rights at the early stages as well. It's not necessarily control, but I suppose if you think of timing your reporting, we control that, I suppose. But otherwise, yeah, it's not too much of an issue. You will get more of that at the Series A later on. So it's very important that you know who the investors are, what kind of value they can bring to your table, because they likely will be having some control terms, especially with their share structure and how they are aligned to your exit and valuations.
Mm-hmm. Yeah, that kind of goes back to what you were talking about really early on in our conversation, that these are long-term relationships, right? Like I think the stat that the average seed stage to an exit, like the time frame is about 7.8 years. It's you definitely want to make sure that you're partnering with people that you want to do business for that period of time. And interestingly enough, for female-led companies, it's only 5.8 years. So that's another interesting stat. So so I got one final question, and then we'll wrap up as close as we can to 11 o'clock. So as we look at the last couple of years, has negotiation and leverage changed as startups have access to like a broader range of VCs and international VC money starts to come into the prairies? Obviously, everybody's comfortable on Zoom now, and we've seen lots of stats about US VC money coming into Saskatchewan and Alberta, and it's been pretty good for us. How does that impact you guys, and what's that look like in terms of the relationships with founders? And
yeah, I'll start us off. It's interesting. It's actually wonderful to see more capital coming into not only the prairies, but across Canada as well. More competition is always great. It makes people like Tim and I work harder for the deals and getting to the founders like yourself. So it's a different landscape, Canada versus US VCs, and the kinds of deals you'll see, the velocity, even just the capital influx. So we do often have founders that have come from accelerators or other programs in the States and are kind of befuddled that you can't raise as much money in Canada at the same valuations. It's a lot more compressed, but it's just a matter of understanding in Canada, your cost of labor or other resources could be cheaper. Maybe not today any longer, but it's still comparatively to the States can be a little bit on the smaller side. So we're not expecting you to raise as much or at such high valuations. It's changing here and there. So that's what we've seen maybe in the past couple of years. But as more money comes in from the global front to Alberta, to other Canadian provinces, I think we'll see the discrepancies level out a little bit more and neutralize towards doing a deal in Canada might look the same as doing a deal in the States. To what effect, I don't know. And I'm also young and in this space, so please take my word at like whatever grain of salt or like pinch of the ocean you want. But nonetheless, I think it's interesting to see that competition coming in. And again, access to networks and connections, right? It's wonderful to have co-investments, Canadian and a US VC, so you're having access to markets from both sides. So it's kind of, it's nice to see from all angles.
Yeah, and just adding on to Yasmine to finish it off. I think there are a lot of pros with global VCs. I think mainly US VCs coming into Canada and the prairies, and like the big pros are there's more access to capital for founders, and US VCs are more. The industry is older in the US, right? So they have a lot more knowledge about just high growth and like tech startups than a lot of Canadian VCs. So it's like that's great for founders and great for Canadian VCs because there's like you can learn from them as well. And then they just have much bigger networks, right? And I think it's like which helps you build your business. And then the con side for us as VCs is like it's more competitive, meaning the prices are higher, and we have to learn how to compete. And we have to learn how to compete with them, right? So it's like it's kind of this double-edged sword where it makes us better as VCs, but now we're also paying more.
Yeah, absolutely. All right. Well, I think that wraps it up. So I want to thank our friends at BDC for sponsoring. This has been super informative, and it's been really great to get to know what you guys are doing, Yasmine and Tim. Is there any best way for people to get a hold of you or follow you or contact your firm that you guys would recommend, and any sort of closing out statements or waves or signs you want to flash to the crowd before we head out of here for the day?
Definitely. Please go ahead and get in touch through LinkedIn. You're welcome to send a message. Just let us know, maybe, or myself in particular, where we met, so that I don't just ignore the connection, that I do actually follow up with you. Or feel free to check out our websites, apply if you're applicable for our fund, or send us an email. Mine's pretty easy, Yasmine@yaletown.com. So I'm more than happy to have a chat. If you're in Edmonton as well, we can grab a coffee or something like that, or see each other at TNT, which is the place to be, right? Every Thursday night.
Every Thursday, yeah.
Yeah, and similar to Yasmine, it's like you can add me on LinkedIn or reach out to me on email. My email is tim@panache.vc. Or we also have a form, just like Accelerate Fund, on our website that you can also kind of fill out to get into our funnel.
Awesome. Okay, thanks again, everybody. I really appreciate this. Super informative. Thanks for your time, Tim and Yasmine. This is great. Thanks everybody for coming. I really genuinely appreciate it. Have a great but wet week.